Before you swipe away, do me a favor, pause the doom scroll. Let the plants fend for themselves a little longer. Ignore the dog, ignore the notifications, and yes, even ignore your spouse for the next few minutes. If your goldfish is staring at you like it knows something you don't, that's fine too. Because what I'm about to walk you through is uncomfortable, counterintuitive, and for some people, infuriating. But if you stay with me, it might also end up being one of the most important market narratives you hear this year. It's Thursday, January 15th, 2026, and what happened over the last 24 hours is something most people were not prepared to process. Yesterday, we talked about the widening gap between silver prices in New York and Shanghai. A gap that didn't just widen, it blew out. Shanghai was trading silver at roughly $14 more than New York. Let that sink in. Two major global markets, same metal, wildly different prices. That's not normal arbitrage noise, that's stress. That's a system telling you something is breaking. New York was hovering in the low 90s. Shanghai was screaming scarcity. That alone was enough to raise eyebrows. It strongly suggested the paper market was losing its grip while the physical market was calling the shots. But then, later in the afternoon, something happened that changed the entire equation. JP Morgan flipped. Yes, that JP Morgan, the institution that has been public enemy number one in the silver world for over a decade. The same bank that built its reputation as the largest short seller in the silver market. The same bank fined hundreds of millions for spoofing, manipulation, and playing games that most retail traders only learn about after they've already been burned. That bank just switched sides. They went from being aggressively short silver to effectively neutral, and then long. They covered their shorts, and not quietly over months, but in a violent, compressed window that most people completely misread. If you don't understand what that means, you won't just miss a trade. You'll miss a regime change. Let's rewind to what everyone saw. Silver in New York dropped $8 in a matter of hours, from around $93 down to $85. An ugly move. The kind of move that triggers panic, margin calls, and emotional decisions. Social media lit up with the usual reactions. That's it, rally's over. Banks won again. Told you this was a bull trap. But that interpretation misses the point entirely. That wasn't organic selling. That was a controlled event. Here's how short covering actually works at scale. When you're short a commodity, you've sold something you don't own, betting you can buy it back cheaper later. If price moves against you, your losses grow fast. And if you're short millions of ounces, you don't get the luxury of clicking a buy button and calling it a day. If a bank like JP Morgan openly starts buying to close shorts, the price explodes upward immediately. Everyone sees it, everyone front runs it. Liquidity disappears, costs skyrocket. So instead, you manufacture liquidity. You push paper into the market aggressively. You smash price. You trigger stop losses. You scare weak hands. You make it look like the rally failed. And while everyone else is selling in fear, you're quietly buying, closing your short positions into that forced supply. That's what happened. The key evidence isn't the drop itself. It's what happened after. Price fell hard, then stopped. It didn't cascade lower. It didn't spiral to $80 or $70. It stabilized. The selling pressure vanished as quickly as it appeared. Why? Because the seller was done. Once JP Morgan finished covering, the artificial pressure was removed. The anchor came off the chain. And now, for the first time in roughly 15 years, JP Morgan no longer has a structural incentive to suppress silver prices. Think about how significant that is. For over a decade, every meaningful silver rally ran into the same wall. Paper dumps, margin hikes, sudden volatility. It didn't matter how strong the fundamentals were, there was always a ceiling. That ceiling wasn't theoretical, it had a name. Now that ceiling is gone. And here's the part that makes people angry. Because yes, it feels unfair. JP Morgan spent years leaning on this market. They paid fines that amounted to rounding errors. Retail investors got shaken out again and again. And now, after all that, they get to ride the upside too. That frustration is understandable, but it's also irrelevant. Markets don't reward fairness, they reward positioning. What matters is this. The biggest suppressor of silver prices just became a stakeholder in higher prices. When a bank of that size owns massive amounts of physical silver, they don't want volatility to the downside. They don't want crashes. They don't want prolonged dips. They defend price. They buy weakness. They change the character of the market. The former ceiling becomes a floor. This is why the narrative just shifted from silver might go higher to price discovery is now possible. And price discovery, when it finally arrives, after years of repression, isn't subtle. Now ask yourself this. Why now? Why flip here? Because JP Morgan sees what's happening globally, and they see it earlier than most. They see the sustained premium in Shanghai. They see physical silver moving east and not coming back. They see industrial demand accelerating, not in theory, but in contracts, delivery schedules, and supply chain stress. They see vault inventories shrinking. They see that Western paper pricing is losing credibility against physical settlement reality. And most importantly, they see what happens when the rest of the world wakes up to it. When manufacturers realize silver isn't just another input, but a bottleneck. When tech companies understand they can't just hedge this away with futures. When funds looking for real assets realize silver is still tiny relative to capital flows. By the time that realization becomes consensus, price won't be in double digits or even low triple digits. JP Morgan isn't chasing a headline. They're positioning ahead of an inevitable repricing. This isn't a conspiracy, it's textbook behavior. Accumulate when perception lags reality. Flip when risk-reward asymmetry becomes too large to ignore. Retail investors, meanwhile, are being emotionally whipsawed. They see volatility and assume failure. They see sharp moves and assume manipulation is still one-directional. What they're missing is that the manipulation playbook didn't disappear. It just changed objectives. The same tools that once capped silver are now aligned to support it. That doesn't mean price goes straight up in a line. It never does. But it does mean the long-term bias has fundamentally shifted. Silver is no longer fighting its largest enemy. It's moving with it. And that's not something you see often in markets. So if you're feeling conflicted, excited but annoyed, bullish but suspicious, that's normal. This is one of those moments where emotion lags structure. The setup doesn't care how anyone feels about it. The only real question now is whether you recognize the shift before the crowd does. Because when they finally do, the conversation won't be about whether silver can break old highs. It'll be about why nobody was paying attention when the rules quietly changed. Here's the part most people aren't paying attention to yet, and honestly, it may be the most important detail of all. While the largest banks and institutions are quietly scooping up silver wherever they can find it, retail investors are being pushed further and further to the sidelines. Not metaphorically, literally. Yesterday, one of the biggest online bullion dealers in the United States rolled out a policy that should make anyone paying attention sit up straight. APMEX announced a new minimum purchase requirement for silver, $10,000 per order. Let that number sink in for a moment. At roughly $90 an ounce, that's around 110 ounces just to get through the door. Most people don't casually have 10 grand sitting around for a metals purchase. Even if they're bullish, this isn't an inconvenience, it's a barrier. And no, this isn't APMEX being greedy or suddenly deciding they don't like small customers. This is rationing, plain and simple. When inventory gets tight, dealers stop wasting logistical effort on small orders. They prioritize volume buyers, institutional clients, and entities that can move size. The guy or gal looking to pick up 10 or 20 ounces, politely shown the exit, this is what a lockout looks like in real time. And APMEX isn't alone. Scottsdale Mint, another heavyweight in the physical silver space, has been blunt about it. Their CEO has publicly stated that this is no longer a retail-driven market. The fight for silver has moved up the food chain. Banks, funds, and large institutions are now competing with each other for what remains. Retail isn't the enemy anymore. Retail is the inconvenience. And inconvenient players don't get seats at the table. This isn't accidental, and it isn't temporary. Big money doesn't want competition from millions of small buyers. They want the metal, all of it, and they want it before the public fully understands what's happening. Gates are closing, doors are narrowing, and once they shut, they don't reopen quickly. So if you've been waiting for the perfect pullback, waiting for silver to drift back into the 70s so it feels safe again, here's the uncomfortable truth. That moment is likely gone. And even if price dipped, access might not follow. You can't buy what isn't available, and you can't negotiate minimums with empty shelves. That window is closing faster than most people realize. Now, let's rewind a bit because this didn't happen overnight. If you've been paying attention over the past year, this sequence has been remarkably consistent. 6 months ago, in mid-2025, silver was hovering around $30 an ounce. Commercial banks were massively short. JP Morgan, HSBC, and others had built enormous paper positions, and the old playbook was still working. Push price down, profit on the shorts, repeat. But the data started changing. Slowly at first, then all at once. The physical market began tightening. The premium in Shanghai didn't just appear, it widened persistently. Discussions around Chinese export controls and strategic stockpiling grew louder. Western vaults started bleeding metal. Lease rates crept higher. None of this was invisible to the banks. If anything, they saw it earlier and in more detail than anyone else. And they adapted. Instead of doubling down on shorts, they began unwinding them. Quietly, methodically, they would engineer a sharp sell-off, shake out weak hands, then cover a portion of their exposure. Price would rebound. Then they'd do it again. This wasn't chaos. It was controlled demolition of their own short positions. That's why the second half of 2025 felt so erratic. Sharp rallies followed by brutal drops. Hope, then frustration. It wasn't indecision, it was transition. At the same time, they were accumulating physical silver. Not ETFs, not promises. Actual metal. Bars moving out of vaults, inventory shifting hands. This wasn't theoretical positioning, it was tangible. And then yesterday happened. That sudden $8 plunge from the low 90s into the mid 80s wasn't a failure of the bull case. It was the final cleanup. Last major short covering event, the books were cleared, the exposure neutralized, and once that selling stopped, price stabilized almost immediately. That's your confirmation. JP Morgan is no longer leaning against this market. They're standing with it. Now here's where things get interesting, because banks don't make this kind of move for a 10% gain. They done T-flip decades-long positioning because they think silver is headed to $95 or $100 and then done. They move when the upside is asymmetrical and the downside is limited. They see much higher prices. And they don't want competition while they build that position. That's why price is unlikely to retrace deeply. A sharp pullback invites buyers. It brings in institutions that missed the first leg. It opens the door for retail again. None of that is desirable when you're still accumulating. So instead, you guide price higher. Gradually at first, then with increasing momentum. You trigger technical breakouts. You wake up algorithms. You attract trend followers. And as the price rises, the narrative shifts from skepticism to curiosity to inevitability. Retail FOMO arrives late, as always. At that point, paper positions can be trimmed for profit, while physical holdings are retained. That's the real prize. Because paper can be recreated, physical cannot. The path from here is unlikely to be smooth, but it is increasingly directional. 100 becomes the new reference point, then 120, then 150. And somewhere around there, mainstream media finally notices. Silver becomes dinner table conversation. Comparisons to Bitcoin start flying around. Analysts who ignored it for years suddenly discover charts. That's when things accelerate. Because none of the underlying constraints disappear. Industrial demand doesn't slow, electrification doesn't pause, vaults don't magically refill. And now, instead of fighting the banks, the market is being pushed by them. Some people are understandably tempted to act out of spite, to sell simply because they don't want JP Morgan to win. That instinct is emotional, not strategic. If you sell into this, you're not punishing the bank. You're supplying it. You're handing over metal they actively want, often at a price they consider cheap. That's not protest. That's capitulation. You don't have to like the players to understand the game. Right now, incentives are aligned. Higher prices benefit anyone holding physical silver, including you. We've seen this movie before. In the 1990s, banks were aggressively short gold, keeping it suppressed for years. Then the fundamentals shifted. Central banks turned into buyers. The dollar weakened. Deficits ballooned. Banks flipped long. Gold went from around $250 in the early 2000s to nearly $1,900 a decade later, a massive move, and the banks rode it all the way up. Silver is smaller, tighter, and more industrially essential than gold, which means when its repricing truly takes hold, the move won't be subtle. This isn't about hype, it's about structure, and structurally, the silver market has changed. The question now isn't whether that matters, it's whether you recognize it before access disappears entirely. Let's zoom out for a moment, because if you strip away the noise, the charts, and the daily drama, what we're really staring at is the possibility of a once-in-a-generation repricing. A move that takes silver from the $30 range to $300 or more. A tenfold shift. That sounds dramatic, I know, but dramatic doesn't mean impossible. It just means most people won't believe it until it's already happened. And if you're holding physical silver, quietly sitting there while everyone argues on social media, you're already positioned for that outcome. Now, to understand why this is happening now, why JP Morgan made its move when it did, you have to understand China. Not the headlines, not the slogans, but the mechanics. China is the gravitational force in this story. JP Morgan knows with near certainty that China is preparing to absorb whatever silver is still available globally. The Shanghai premium isn't a temporary glitch, it's a signal. And signals like that don't fade quietly. They resolve violently. China's export licensing framework has effectively created a one-way door. Silver can enter China, but it doesn't leave. Once it's in, it's spoken for. Locked into industrial supply chains, long-term projects, and strategic reserves. Combine that with China's expanding solar capacity, EV manufacturing, electronics production, and infrastructure build-out, and you have relentless demand for a metal that already struggles to meet global consumption. This isn't speculative demand. This isn't people buying coins and putting them in safes. This is industrial necessity. Silver is being consumed, not stored. And the world simply doesn't produce enough of it to satisfy what's coming. JP Morgan saw this months ago. They watched the Shanghai price diverge. They tracked inventory flows. They saw physical metal disappearing into Asia and not returning. And they understood the obvious conclusion: Western prices cannot stay disconnected forever. Markets tolerate distortions for a while, but eventually the tension snaps. When that happens, the adjustment won't be polite. Maybe it's a delivery failure. Maybe it's a force majeure declaration. Maybe it's a regulatory intervention or quiet admission that paper claims exceed available metal. However it happens, the Western price won't gradually catch up. It will gap. And anyone holding physical silver when that gap closes will wake up to a very different balance sheet. JP Morgan didn't wait for that moment. They front-ran it. They unwound their shorts, flipped long, and accumulated physical metal while the narrative was still confused. They positioned themselves ahead of China, ahead of the public, and frankly, ahead of most institutions. That's not luck. That's strategy. It's game theory in action. They're playing chess, and most of the market is still arguing about the rules of checkers. But this story doesn't stop at silver. This is also about currency, specifically the slow erosion of trust in the US dollar. The widening Shanghai premium isn't just about supply shortages, it's about confidence, or the lack of it. The East is voting with its balance sheet. They're buying gold at prices that would have sounded absurd a few years ago. They're paying premiums for silver. They're accumulating commodities and real assets while reducing exposure to treasuries and dollar-denominated debt. This isn't a sudden crash scenario. It's worse, actually. It's a slow bleed, a gradual loss of faith that accelerates as more participants quietly make the same decision. And JP Morgan sees that too. They see a future where the dollar buys less, where purchasing power erodes, and where hard assets reprice sharply higher. Not because they changed, but because the unit of account did. That's why silver matters so much in this context. It's not just an industrial metal. It's a monetary metal that still trades as if it's neither. And that mispricing is exactly what creates opportunity. Now let's talk about what the next 6 months likely look like, because this is where expectations need to be realistic. In the near term, think weeks, not years. The price probably consolidates. $90 to $100 becomes the battlefield. JP Morgan and others continue to accumulate. Dips get bought. Volatility remains, but the lows keep rising. It's not explosive yet, and that's intentional. Then a catalyst hits. It always does. Maybe it's a COMEX delivery issue that can't be explained away. Maybe a major industrial buyer publicly admits they can't secure supply. Maybe China tightens export controls further. Maybe the Federal Reserve blinks and announces another round of monetary easing. The trigger almost doesn't matter because the structure is already fragile. When it breaks, price doesn't politely step higher. It jumps. A move from 100 to 120 or 130 in a single session isn't T just possible, it's S likely. That's when media coverage starts. That's when silver suddenly becomes interesting again. Retail FOMO returns. Momentum traders pile in. Algorithms flip from sell to buy. That's the transition phase. From there, the move accelerates. 130 becomes 180. 180 becomes 220. And by the time silver trades north of $200, the physical market is effectively gone. Dealers will have nothing. Mints will be months behind. Premiums won't be $10. They'll be 30 or 40 if you can find metal at all. At that point, price is whatever the seller says it is. That's when things go vertical. 220 to 300 doesn't take years in that environment. It takes panic. It takes realization. It takes people buying not for return, but for protection. Silver stops being a trade and starts being a lifeboat. And once that psychological shift happens, models break down, targets get revised, and history books get new chapters. Now, there's one lingering fear that needs to be addressed because it keeps coming up. The concern that JP Morgan will simply pump the price, dump their position, and leave everyone else holding the bag. It's a fair question, but it misunderstands the situation. If JP Morgan dumped physical silver at $200 and crashed the price, who steps in? China. Instantly. Every ounce gets absorbed, supply vanishes. And JP Morgan is left without metal, without leverage, and without exposure to the real move that follows. That's not a rug pull. That's strategic suicide. They didn't flip long for a quick trade. They flipped because they understand this is a generational setup. They know the shortage is real. They know industrial demand isn't slowing. They know currency debasement isn't reversing. And they know silver offers asymmetric upside with limited long-term downside. In other words, they're not trading this. They're holding it. And whether you like JP Morgan or not is irrelevant. This isn't about personalities. It's about incentives. Right now, their incentive is the same as yours, higher prices. That alignment doesn't happen often, and when it does, ignoring it is expensive. So here's the bottom line. JP Morgan has flipped from short to long. The biggest historical suppressor of silver prices is now a supporter. The ceiling that capped rallies for years is gone. A structural floor is forming. Physical supply is tightening. Retail access is shrinking. China is buying relentlessly. And the dollar is slowly losing credibility. This is not a drill. This is not hype season. This is a market transitioning from manipulation to discovery. If you already hold physical silver, your job is simple. Don't panic, don't trade emotionally, and don't hand your metal to the very institutions that want it. If you don't hold silver yet, understand that access matters as much as price, and that window doesn't stay open forever. This is John A.G. from Currency Archive. It's Thursday, January 15th, 2026. JP Morgan has flipped long. The endgame is in motion. Retail access is tightening. The banks are front-running China. The timeline is accelerating, and the squeeze is real. Hold the line.